Financial markets. What are financial markets? When you see the word market, you probably think about a marketplace, like some physical place where people come to shop for something. Well, financial markets does not have to be some centralized location where buyers and sellers meet and trade um, products for cash. But it is a more general term on where financial securities are bought and sold. So what do you mean by financial securities and how can they be bought and sold? First, financial securities include two important things: stock shares and corporate bonds. So these are the two financial securities that a company may sell in order to raise money, for example, to expand and grow its business. What are stocks? Stocks represent um, profit, the residual after all expenses such as wages to employees, money to suppliers, taxes, interest payments on loans have been paid. So this is what's left for the owners of a corporation. And the owners of a corporation are stockholders, people maybe like us, people who might be coming from all over the world who are buying shares of stock of some company that they like. So shares of stock are also called equity. Equity, you can think of a standard balance sheet which has assets on the left hand side and liabilities and equity on the right hand side. So equity is what you would get if you sell all assets for cash and use the cash to pay off all liabilities, all debts that you owe to somebody, whether it's suppliers or banks or other lenders. So equity is the residual, it's what's left. And that's what's left for the owners of a corporation. So stockholders, the owners, they receive what we call dividends. And basically, and this time you can think of an income statement. That's nothing but net income, the bottom line of an income statement, divided by how many shares there are. So that's the dividend per share. So shares of stock is one of the two types of financial securities that a corporation can sell. The second one is corporate bonds, which is also called debt, or how much is borrowed. So when a company sells a bond, it basically borrows money from whoever buys that bond. Let's say you buy a bond from the company. You are like a mini bank. You just lend the money to the company. How much money? Exactly how much you paid for the bond. And so the company, as a borrower, will be in return paying you interest. This is something we will be looking at in Chapter 7 in this class. And stocks will be covered in Chapter 8. So the firm pays dividends to stockholders on the shares that they bought and interest payments on bonds to the bondholders. This figure on this slide, it's figure 1.2 in the textbook, shows cash flows between the firm and the financial markets. So the firm is the yellow shaded area on the left, the big box. The financial markets is the sort of grayish, bluish area on the right. The arrow labeled as A, firm issue securities, shows how money comes to the firm from the financial markets. What exactly is it? All it is from the previous slide, the firm selling things like stocks and bonds to whoever wants to buy them and receiving money for that. Now the firm has more money to work with. It has just raised cash. Then the firm invests cash into its projects, into its business. Hopefully it grows larger, makes more money. What happens to the money it gets? Like revenues, essentially. It has to, basically it goes, we say, in three main directions. One, that's labeled as F on the figure, dividends and debt payments. that's essentially the money going back into the financial markets. Dividends as payments to stockholders, and interest payments as payments to bondholders. That's one of the three directions where the money flows out of the firm, the cash outflows for the firm. The second direction is labeled as C, cash flow from firms' assets going to the government and other stakeholders, labeled as D. What is that? Taxes. That's basically all it is. It's mainly taxes that corporations are required to pay on their corporate income every year. And then what's left is labeled as E, reinvested cash flows. So some money will remain. What does the firm do with it? It kind of, uses it for its businesses, to expand even more. So the money gets reinvested. The money flows as dividends and debt payments to the financial markets. Part of the money is paid as taxes, and the remainder is reinvested back into the firm. Then the next slide talks about looks at a little bit more details on how firms sell stocks and bonds. So a firm decides to expand. Maybe it needs money to buy its competitor, right? It's probably millions of dollars, if not billions of dollars, that we need. No firm would have that kind of cash lying around, so it would need to raise cash. It can do that by selling stock shares or by selling corporate bonds, or both. So investors, stockholders, and bondholders buy those two types of financial securities, and now the firm has raised some cash. This is called primary markets. Stocks and bonds are sold for the very first time. They can be sold as a public offering, meaning anybody in the world can pay the listed price and buy stocks or bonds. Or they can be sold in a private placement, which means only a relatively small group of rich investors has access to those financial securities. Now, investors just bought stocks and bonds. What happens next? What happens is what is known as the secondary markets. That's stocks and bonds being resold over and over and over and over again. They start switching hands. They're traded on Wall Street, on New York Stock Exchange, they're traded online. They start switching hands. All of that is called secondary markets. There are no market number 3, tertiary markets, market number 4. It's all called secondary markets. And they can be resold through dealers or through brokers in an auction. So let's look at a couple of examples of how secondary markets work for stocks. Dealer markets and auction markets. Dealer markets are also known as over-the-counter markets. That's because there are many locations where the trade occurs. There is no one physical location. The dealers, they buy stocks and then they sell them on the phone or electronically online to potential buyers. So they basically bear the risk of not being able to sell either all shares or at the price that they would like to get. But in general, they're buying them for a low price, sell to the interested buyers at a high price, and they make profit on that difference in price, which is known as the bid-ask spread in finance. An example is Nasdaq, which stands for the National Association of Securities Dealers Automated Quotations. That's where over 3,000 company stocks are traded on regular basis. It's primarily smaller company stocks, and the trading is not as active as in the famous New York Stock Exchange. The New York Stock Exchange is an example of an auction market, the second type of secondary market. This is a centralized location. There is a physical location on Wall Street in New York where stockbrokers are physically present to trade on behalf of their clients. It all looks like an auction. They're, bidding their prices, and eventually the trade, takes place. So New York Stock Exchange is open on business days, Monday through Friday, excluding national holidays, 11 of them, and weekends. So there are generally 250 to 252 trading days in a year, and that's it. This is where there are restrictions on which companies are allowed to have their stock listed on this trading platform. It's large companies. In order to be listed, they need to be worth at least $100 million. And this is where you see, again, close to 3,000 different company stocks traded daily.